Hey everyone, and welcome to Moementum channel. My name is Mo, and in this video, I want to share with you two undervalued stocks in the stock market right now, and that are great for investors to watch or perhaps even buy in the stock market in the upcoming months. These two companies are in information technology as well as healthcare sector, and one of them is a dividend-paying stock as well. So let's get into this video. Right, the first company that we want to talk about is Twilio. It is an American company in the information technology IT sector, and it was last traded in the stock market at the price of $359.43. However, the company is showing a fair valuation of $420.73 USD based on Finbox fair value. Finbox calculates companies' fair value based on its intrinsic or underlying worth. Based on Finbox fair value, Twilio has an upside of 17.1% upside with an uncertainty level of high, yet making it a good potential investment in the IT sector for many investors. All right, we're going to take a closer look at some of the financial statements for the company Twilio, and from there on assess whether this is a good stock to consider and how they are performing in terms of various financial metrics. As you can notice here, for the company's revenue since the fiscal year of 2015 all the way to 2019 fiscal year, you'd notice how the company's revenue has nicely grown over the past several fiscal years. In fact, it's double-digit revenue growth, and in 2019, the revenue growth was closer to 74%. If we look back at the most recent fiscal year, in fact, if you look at the company's trading 12 months revenue as of fiscal year 2020, ending in late September 2020, the company reported $1.5 billion in revenue, which is definitely much higher than the revenue reported for the fiscal year 2019 at $1.13 billion US dollars. Now, one red flag here is the fact that company's net income is actually negative still, and in fact, the net income is declining. Here's how these numbers pan out. So for net income, according to the last fiscal year of 2019, they were reporting hovering around $307 million net loss. So that's one thing we are noticing. And similarly, if you look at the last trailing 12 months, you would notice for their net profit is actually even worse, sitting at negative $402 million. That said, the company is really rapidly growing, and for many companies that are at this stage of really rapid expansion and with the considerable revenue growth, it is sometimes understandable that they actually are loss-making at this time. And you notice a large portion of that revenue is actually being spent on their R&D, research and development expenses. You can notice how their R&D expenses are growing definitely year over year. Similarly, they're also growing their selling and marketing expenses as well as their general and admin expenses over the years. Now, looking at company's balance sheet, we want to take a look at the company's current assets and how that current assets compare to their current liabilities. You notice that the company's current assets sit at $3.5 billion, whereas their current liabilities is only at $326 million. So huge difference there. This results in a positive current ratio, and it's definitely a healthy sign for this company. Now, if we compare their total assets, it's sitting at $6.7 billion in the trailing 12 months, whereas their total liabilities is only at $961 million. Again, a very healthy sign, seeing that the company's total assets is way more than their total liabilities. Looking at the company's cash flow, they're actually showing a negative free cash flow, but they're showing a positive $30 million cash flow from their operations. All right, so let us take a closer look at the company's peer benchmark. You notice here that the company has a market cap of 54 billion US dollars. The company has shown a 1-year stock price total return of 189.1%, which is a lot better than their peers' return of only 77.1% return. And if you compare it to the information technology sector, it's actually crushing it, because the sector return, 1-year return, has been only at 7%. Now, company is definitely a lot more volatile, though, compared to the information technology sector as well as their peers. They have a beta of 1.51, and beta is a measure of stock volatility compared to the overall market price volatility when it comes to stock market. So a higher beta, especially the one above 1, kind of suggests that the stock price is a lot more volatile than the general market. Twilio does not pay any dividend at this time. Let's take a closer look at Twilio's last quarter earnings. Their last quarterly earnings report was announced on 26th of October 2020, in which they actually reported an earnings per share of 4 cents. It was a positive earnings per share report, and it actually surprised analysts by over 200%. They also reported a quarterly revenue of $448 million, and that surprised analysts' estimates by 10%. Despite that top and bottom line kind of surprise and beat, the stock nonetheless went down the next day by 6.47%. And in fact, that seems to be the story for majority of their stock reaction after the quarterly earnings has been released. You look at it over the past several quarterly earnings reports, for majority of the times, the stock actually went down. Nonetheless, at the times where the stock actually reacted positively, where, for example, May of 2020 or November of 2018 or August of 2018, the return on the positive side has been double digit. So that's something for you to kind of keep in mind. Whereas every time the stock went down, it's actually been one digit decline, at least over the past 10 quarterly earnings reports. So something for many investors to keep in mind. Perhaps it might well pan out for you because the upside potential is a lot higher than the one digit negative return of the stock. In terms of their upcoming quarterly earnings, it is anticipated to actually announce the February 17th of 2021. And according to analysts, they're anticipating a negative earnings per share of about 6 cents. And for the quarterly revenue, analysts estimate revenue of $454.2 million. Now, keep in mind, over the past 3 months, 90 days, 22 analysts have actually lowered their estimates for earnings per share for the stock. Now, one thing I want to show you is, if you look at it over the past 8 quarterly earnings reports, the company has been consistently able to surprise estimates positively, both in terms of their earnings per share, EPS, and their revenue. So that's really a good sign for a company in terms of their ability to surpass analyst estimates. Now, for those of you who might not be familiar, Twilio, along with its subsidiaries, provides a cloud communication platform that enables developers to build, scale, and operate communications within software applications in the US and internationally. The company has been founded in 2008 and is headquartered in San Francisco, California. All right, moving on, let us take a look at the second company that is undervalued in the stock market right now, and it is called Bristol Myers Company, which is a pharmaceutical and healthcare company in the US. The company's stock, which is traded on New York Stock Exchange with ticker symbol BMY, was last traded at the price of $61.43 USD, and it was actually down by 1.38% in the last trading day. Nonetheless, the fair valuation, according to Finbox, is showing to be $71.61, showing an upside potential of 16.6% based on the intrinsic or underlying worth for this stock. All right, now let us take a closer look at the company's revenue over the past several fiscal years and see how they are doing. Another positive sign for us, you can see the company is consistently increasing its revenue, and in the fiscal year of 2019, their revenue reported was $26.1 billion US dollars. Now, most recently for the trailing 12 months, if you look at it for the company, their revenue is showing to be at 39.4 billion US dollars in the trailing 12 months as of September of 2020. That's quite positive. The company in trading 12 months is actually showing a negative net profit. In fact, they're reporting a net loss of $44 million. Now, looking more closely, let's take a look here how the net income for the company has changed over time. You notice here that it's kind of hit and miss. So, and then it's actually inconsistent in a sense that, increases over time, but decreases. So for example, in 2015, they reported closer to $1.5 billion net income. And in the year 2018, they probably had they're one of the highest over the past 5 years. Whereas in 2019, they were hovering around $3 billion, you'd notice. So that's positive. The downside to that is, though, for the trailing 12 months, at least as of September 20th, as we saw, September 2020, we saw that they are showing a negative net profit there. So keep that in mind. And that's actually one of the reasons that if you look closer to the company's dividend, well, it's a dividend paying company, their payout ratio is showing negative because the company based on the trading 12 months is not profit making and they're loss making, and that just causes the payout ratio to be totally out of whack. The company has been paying dividends, and in fact, they've increased their dividend amounts over the past 4 years straight, so that's positive. Their dividend yield currently sits at 3.19%. The company's next dividend payment date is February 1st, and any shareholders who had shares of Bristol Myers before December 31st is entitled to 49 cents in dividend payment in cash for each share that they own. We want to take a closer look at the company's earnings in the past quarter. In the last quarterly earnings report that was released on November 5th, they reported earnings per share of $1.63, which surprised analysts by 9.3% positively. And also they reported $10.54 billion in revenue, which again surprised analysts by 1.9%. Nonetheless, the stock price after that announcement, the next trading day, went down by 2.49%. If you look at the past 10 reactions for stock price after the quarterly earnings report was released, you'd notice that majority of the time actually stock price has gone up, but in 4 times over the past 10 quarterly earnings reports, the stock price went down after that release. But the reaction has not been crazy. For the most part, it's actually sitting at 1-digit returns, either positive or negative, depending on how the stock did and how the stock market reacted. So keep that in mind. In terms of the next quarterly earnings, the announced date is expected to be February 4th, 2021, and the company is expected to return an earnings per share of $1.42, less than their past quarter, according to analyst estimates. They're also estimated to report a revenue of $10.74 billion, slightly higher than what they actually reported in the past quarter. And nonetheless, over the past 90 days, 3 analysts have increased their expectation for earnings per share, whereas 9 analysts have lowered their expectation. You can see over the past 7 quarterly earnings reports, for the most part, they have been able to surpass analyst estimates, both in terms of earnings per share and their revenue. However, there was one incident back in Q4 of 2019 where they missed analyst estimates for their revenue. Looking at the company's balance sheet and seeing how they're doing there, in their trading 12 months, they're showing a current asset of $34.2 billion. And if you compare that to their current liabilities, you notice that it well exceeds their current liabilities of $20.4 billion. That's a positive sign. We also want to hope to see that the total assets exceeding their total liabilities, which is in fact the case. The total asset is showing $125.5 billion, well exceeding their total liabilities of $75.3 billion. Now, looking at company's cash flow, their trailing 12 months cash flow from operations is showing a positive $12.4 billion. And in fact, their free cash flow is also showing $11.69 billion, which definitely a positive sign. And you can see how it's actually growing over time. So definitely very positive there. Let us also take a close look at the peer benchmark review. So you notice here the company Bristol Myers has a total market capitalization of $138.8 billion, which is larger than their average peer size of $101.1 billion. The company showed a 1-year stock price total return of only 0.7%, which is definitely lower than the sector. On a more positive note, the company's beta is only at 0.65, which suggests the company is less volatile than the sector as well as compared to their peers. So typically a beta of under 1 is more desirable, especially for investors who are not looking for a lot of rapid stock price volatility. So that could be perhaps a safer investment. I personally do own shares of Bristol Myers in my investment portfolio and absolutely love the dividend income. I do own fractional shares of Twilio, but do intend to add more to my shares of Twilio as well, because I do think long-term Twilio is a great company to invest in. Let me know what you think of this video and whether you own shares of Twilio or Bristol Myers in your stock investment portfolio. I hope you found this video beneficial and you gained something of value from it. If you did, please be sure to give this video a thumbs up and share it with someone who might benefit from the video as well. And of course, don't forget to subscribe to Moementum channel. Here on Moementum, we post weekly various videos about stock market investing, finances, and financial freedom. With that, thank you guys, and I hope to see you next time.